Well, staying now in that broader mining space, and the Africa Down Under Conference is happening in Perth, and one of the big names taking part in the conference is Perseus Mining, and I'm pleased to say its Managing Director and CEO, Jeff Quartermaine, joins us now from our Perth studio. Plenty to talk about, Jeff Quartermaine, but I wanted to start firstly with the concept of this transition that you've made into a West African gold miner. In particular, look, what the transition has been like, the challenges, but also the opportunities that you see.
Well, look, we've always been a West African miner, and there's enormous opportunity over there. I mean, it's very well documented that geologically it's hugely prospective, but also in addition to that, the governments, the host governments and communities are very welcoming of foreign investment and are encouraging us to move forward with our projects. So we're very comfortable operating in that space.
How long can you be confident of having that? And I note in your presentation you refer to it as a social license to operate, because sovereign risk goes with the territory, I would have thought. And how do you view the potential of that welcoming of foreign investment potentially shifting in outer years?
Well, look, sovereign risk applies to every jurisdiction you operate. I mean, there is sovereign risk in Australia, for instance. You were just speaking earlier about the potential for increasing royalties in Australia. The things that occur here exist in those parts of the world. Now, part of our strategy is to seek geopolitical diversification, and that is to have operations in several countries for the very express purpose that we do know that governments come and go and their attitudes change. So by having a spread of assets across a number of countries, we believe that we can mitigate whatever risk arises from sovereign changes.
Jeff, Tony Davison from Henderson Maxwell here. Just in terms of expectations looking ahead, I believe the company produced just under 180,000 ounces of gold last financial year, but you're guiding somewhere between 250,000 to 280,000 this year. Where does most of that increase in production come from? Which of the assets are going to contribute the most to that?
Well, it comes from two sources. Our Allin mine is moving into a high-grade zone, so we'll be certainly getting a boost in production from there, and we're actually seeing that coming through as we speak. Also, we're developing our second mine. Our second mine, Sissingué, starts production in the first quarter of next year. So by the end of fiscal 18, we'll have gold coming from two separate operations, cash flow coming from two separate operations, and that accounts for the large kick in performance compared to fiscal 17.
And just in terms of cash costs associated with that, I think the reported period was around $1,330 an ounce cash cost, but you're looking to bring that down to $950 to $1,100, I think, is the guidance. Again, what's sort of contributing the most in terms of that reduction in cash cost per ounce?
Well, you need to understand that the cash costs applied for the full year, and our last year was a year of two halves very distinctly. In the December half, we were spending very heavily on capital development works around the sites, and so that automatically knocked up the unit cost. When we moved into the June half, the costs came down quite significantly as our production went up and our cost base went down. Now, moving forward into the next year, of course, with higher production, your unit costs will come down, but we're also working every day at trying to reduce our cost base to the best of our ability.
Do you have a longer-term ambition in terms of an all-in cash cost for the company, for the mine?
Yes, very much so. We're heading towards around the $850 an ounce level across all of the operations, and certainly Sissingué will contribute very well to that. It's about $650 an ounce, and our third project, Yaouré, which we'll have a feasibility study completed later this year. At this early stage, it's looking pretty good as far as those costs are concerned, and we expect that they'll be well below what we have experienced in the Ghanaian mine to date.
What about on the price side? Obviously, a lot of focus has been on the increasing spot price of gold, courtesy of, take your pick of some of the geopolitical issues at the moment. How hedged are you? What sort of price are you realising at the moment for what you're producing?
Well, we have a hedge policy in place where we can hedge up to 40% in a given year or 30% on an 18-month horizon, and we do have that hedging in place. And at the present time, we are delivering into a combination of spot and also our hedge book. Our hedge book runs at around $1,276, so it was reasonably healthy in any event. And so, with the addition of some spot sales north of $1,300, we're doing quite well, thank you.
Jeff, just in terms of some of those hedge costs there, I think there were some one-offs in the result there which reversed a gain in the hedge book in the previous year. Just in terms of your view looking forward, are any of those sort of one-offs behind you in your view? Obviously it's heavily dependent on the gold price of the day, but do you think for the most part some of the unsettled financials that the company's sort of reported, as you said, 6, 9, 12 months ago, are on the way out now?
Well, some of them most certainly are. I mean, we did incur a fairly significant cost in settling a legal case associated with an acquisition that we inherited last year. But quite aside from that, though, we do, all of our business is run in US dollars, and so when we report in Australia, we're bringing it back to Australian dollars. And of course, it depends very much where the exchange rate is as to whether we incur a loss or a gain. I mean, I should point out, in fiscal 15, we reported a $100 million profit, of which about 50 was foreign exchange gain.
Goodness. This
year, in fiscal 18, fiscal 17, sorry, we recorded, I think it was $16 million loss on foreign exchanges movements, which, in a sense, it's a non-cash item. It's really revaluation of intercompany loans, which is a fairly technical accounting, a loss per se. I mean, it is a loss, quite clearly, but it's not something that's going to affect the underlying business. The key thing for us, and I think for our shareholders, is to generate cash and to be able to distribute that to shareholders and reinvest for the future.
All right, Jeff Quartermaine, got to leave it there. Appreciate your time this morning. Thank you.
Thank you very much.